how do you go about convincing somebody that those actions actually have been effective, that easier policy affected through LSAPs and guidance is having a positive effect on economic activity?
Well, I mean, this is a very good and very difficult question at some level, and it's not a question that's really specific to the current environment. It's always hard, and there's, as you well know, decades of research trying to understand what the effect of monetary policy on the economy is, because we can't really run the counterfactual. So what can we do? We can look, there's pieces of the transmission mechanism that we can kind of observe, that are tangible enough that we can feel them. So the effect of either the forward guidance or of LSAPs on interest rates is directly observable. Almost directly observable is the effect on mortgage refinancing, which surges in the immediate aftermath. But from that point forward, it is certainly the case that we're using a model which says, based on history and based on past experience, a certain change in interest rates tends to translate into a certain change in activity. And all we can really do to refine that is ask ourselves, are there reasons to think that the model wouldn't apply now as it normally applies? So, in deference to your question, some of what I was talking about in my talk was one reason why the model, through this term premium effect, might not apply. In my own view, the expectational channel, the part that we work on with forward guidance, I don't see a reason to think that that would be stronger or weaker in the current environment. Of course, there are lots of uncertainties, but my baseline estimate would be to say those effects ought to work as they normally do. And of course, there's so many headwinds facing the economy, it's hard to kind of unscramble to do the counterfactual.